So lots of people overcomplicate it when it comes to finding your trading style. But it's actually very simple. And in this video, I'm going to break down exactly step by step how you can find your own trading style in the markets that works for you and your lifestyle. So first of all, let's start with going through the different types of trading strategies that are at your disposal as a trader. You may have heard of some of these, you may have not. Let's go through them. Starting with directional trading, this is the most common, the one you will all be familiar with, where you go long or short on an asset expecting it to go up or down. Very simple. You also have relative strength trading. This is where you say Bitcoin is going to outperform Ethereum. So to express that, you actually look to go long Bitcoin and short Ethereum. So you're not taking a directional bet. Instead, you're taking a bet on the relative strength of Bitcoin over Ethereum and looking to profit through that. Now, you also have arbitrage trading. This is where, for example, you buy Bitcoin on one exchange, and if you see it trading at a higher price on another exchange, you look to sell it on there to capture the difference. That is, in very simple terms, the basics behind arbitrage trading. You're looking to capture a spread generally through platform to platform inefficiencies. And then you have market neutral trading. So this is market makers. They provide the passive side, the limit orders, the liquidity on your exchanges so that you can get filled in your positions at all times. They take the other side of your bet, which is one way how they make money. And they also often get given negative trading fee rates from the exchange to incentivize them to provide that liquidity in the markets, because there are moments in the markets when no one wants to provide liquidity, and the person taking the other side of your bet, allowing you to get that trade on, are those market makers. So those are the four different types of trading strategies out there. As a retail trader like yourself, you're going to have access to directional trading and relative strength trading, arbitrage trading, and market neutral trading. As a retail trader, you don't have any edge there because those who have the best latency, the best equipment, they're the ones who win in that game. So we'll focus on the top two strategies. Next up, the different trading types. You have systematic. This is where you have a rules-based, objective approach to your trading. So entry, long when price crosses the 50 EMA, stop loss below the swing low, take profit when price crosses below the 50 EMA. That's an example of a systematic approach. It tells you exactly what to do. It's binary, it's yes or no. Has my rule been met for entry, stop loss, or take profit? That is otherwise known as mechanical trading. You also then have discretionary trading. So that's the opposite of systematic, where you actually go long or short and take your bets based on your hunch in the markets, based on what you're seeing, and it's not through any objective set of systematic rules. You have automated trading. So this is where you take a mechanical system, a systematic approach, and you actually code it so that an algorithm can automate that strategy going forward without you needing to be present to execute the strategy. And you also have high frequency trading. So this will be your market makers placing hundreds of orders per second. Now, as a retail trader, the trading types that you're going to thrive in are going to be one of the ones with a green tick. It won't be high frequency trading because, again, that is where the institutions, those who have the best equipment, have the most edge. But plenty of profits to be made being a systematic, automated, or even discretionary trader once you get the skill. So, the different trading styles are as follows. You can be a scalp trader. This is where you generally trade on the 1 minute to 15-minute time frame, so intraday, meaning you open and close your trades within the same day. You're looking to capture momentum as a scalper. The key is it's always going to be trend trading. When you enter, you're expecting price to go immediately in your direction as a scalper. Whereas a day trader is slightly different. You're not always expecting price to go immediately in your direction with momentum. You can both trend trade and mean reversion trade, and the time frames are 15-minute to 4 hour, and that is again intraday, opening and closing the trade within the same day. You have swing trading. This is going to be on the 4 hour to weekly time frame, so multi-day to multi-month hold times. And finally, position trader. This will be weekly time frame plus looking at those multi-month holds. So those are the different trading styles. Now, the best path that I recommend as a retail trader is to be a directional trader. So going long or short, expecting price to go either up or down. It's to be systematic, at least to begin with, taking that rules-based approach. And only over time, once your skill increases, do you start deploying some discretion into your strategy. But overall, I always recommend having that systematic foundation, only using discretion to actually tell you when not to trade rather than to tell you when to trade, because we never want to trade off our hunches or our emotions, because we can never get any data behind that. How can you test it? How can you therefore be confident in that strategy if there's nothing statistical backing it? Whereas with systematic approaches, you can back test it, you can live test it, you have all of the data for the system to give you confidence in the markets. So when you add discretion, it's only to tell you when not to trade and when conditions may be actually suboptimal for your system, and that can give you a further edge. And later on, you can add automation to your systems if you wish, and if you are a coder. So that's the best path I recommend as a trader. Now, overall, you need to build trading systems and find a style that suits your lifestyle. So, created a cheat sheet here. Whether you want to be a position trader, swing trader, day trader, or a scalper, or a mixture of both, or maybe all of them. Me personally, I trade all of these styles at the charts. Here is the checklist. So, if with your 9 to 5, your business, or whatever occupies your time from a day-to-day basis, week-to-week basis, if you are only able to check the charts one time per week, then the weekly time frame is for you, and you're going to be a position trader, because that means all you have to do is check the charts at 12 a.m. UTC, Sunday night going into Monday morning on the new weekly candle to see if your system rules have been met or not. Very simple. Now, if you can check the charts one time per day, then you can trade on the daily time frame. That means you can be a position trader or potentially even a swing trader. This means you only need to check the charts at 12 a.m. UTC at the end of the day. So when that daily candle closes, to see if your rules have been met. Next up, you have the 4 hour time frame. You'll need to be able to check the charts at least 4 times per day, and that allows you to become a swing trader. And again, multi-day, multi-week holds. If you are someone who can check the chart that many times per day, and anything below the H4 is where you can now become a day trader. This means you can check the charts 10 to 18 times per day. In other words, you've got periods where you have a few hours at the charts and you can potentially trade some periods. And that means you can have intraday strategies where you're opening and closing potentially multiple trades per day because you're on those lower time frames. And anything below the 15-minute, that means you need to be available for a full trading session. So maybe that's the London session or the New York session. And this is the stock market opening and closing times for anyone wondering. Or maybe the first few hours of the daily open is when you have time available. If that is you, then you can be a scalper, you can be a day trader, swing trader, or position trader because you have that time available. And if you can trade that full session, then you can trade any system during that period. So everyone's situation looks different. Some people work 9 to 5 very heavily, Monday to Thursday, but maybe you have the full Friday where you can actually trade full sessions and can deploy some day trading or scalping strategies. Maybe you don't like being at the charts. You don't want to be on there all day, and maybe swing trading or position trading, checking the charts once per day is actually for you. Again, that comes down to you, your lifestyle, how your week to week, day to day is going. But what you need to do is build a system, build that trading style around your lifestyle so that you can actually take the trades from your system so that you can then have success in the markets. Because if you can't take the trades from your system and you're just not able to be at the charts, then you have to call it for what it is and find a trading system that actually suits you. So that is how to find your trading style in the markets.